Back with India Market Open and on Talking Point today. A very special guest in our studios, Vikas Pershad. Needs no introduction, MNG Investments with us here. Vikas, great having you as always. Thanks so much for joining in. And good to see you in person, by the way.
In person is always better.
Yeah, I agree completely. I wonder if you get the same feeling about looking at India in person and thinking that, oh, are we in that value zone now?
Well, today is a signal that maybe we are, but we have a long-term horizon. We have a large allocation to India, but we have large allocations to other markets in Asia. I can understand over the last year and a half, why India might have underperformed. There's been a lot of reasons for that. A great run from 23 to 24, actually over the last 2 decades. And when you look at what is moving in North Asia, tech hardware, inexpensive equities in Korea, it makes sense that India in the short term would underperform. But if you are a long-term investor, the market here is broad, it's deep. It's why I'm here. It's why I'm excited about India for the long term.
So you guys diversify across the Asian landscape as well, if I'm not wrong. Mm-hmm. So for you, the choices are there, and yet you are thinking that India might now be a good place to deploy long-term money.
Well, we have lots of different strategies. In our India strategy, we are fully deployed. We always are. Our view is we express our views through security selection, not on timing the market with holding more or less cash. In our broader Asia ex-Japan strategy, we have been overweight North Asia relative to South Asia. So underweight India over the last couple of years, even though in India we've been fully deployed. That is nothing to disparage the long-term opportunity here. It's just in a broader context, 18 months ago, there were better opportunities. And so far that has been the right call.
I do want to ask about rotation. And you've talked about the fact that you don't blame shorter term investors for going to markets that are growing significantly faster than India.
Right.
But if you talk about the fact that valuations have caught up quite significantly, they may still on a multiple basis be cheaper. But in China, there are issues of slowing growth. There are issues with regard to birth rate slowing. All of those population issues. You have the fact that anti-involution continues to be a situation. I'm wondering when you anticipate flows to change. And I know this question has been often asked over the course of the last several months, but is there a tipping point that you see?
Not a tipping point, but we might be getting closer. Partly because of the historic divergence between India and other emerging markets. And also the fact that the genuine long-term story in India is very much intact. If anything, the markets are broader and deeper now. Companies are smarter now. Corporate governance is improving. Balance sheets are clean. Margins are high. And so there's for long-term active managers, there's a very big opportunity here in India. On some of these top-down issues, like in China, falling birth rates, same thing in Taiwan, in Singapore, South Korea, and in Japan. But that doesn't take away from the bottom-up single stock investment opportunities. Yeah. Just one stat is if you look from 1997 to 2022, 25 years after the handover of Hong Kong, just if you take that as a bookmark, for 25 years, the Hang Seng index was roughly flat. But you had a lot of companies in China that went up 30, 40 times. In India, the Nifty in local currency terms was up almost 20 times in that period. But you had a lot of companies that materially underperformed. They went to zero. That just highlights that if you are an active manager, there's a lot of ways to add value. And whether the overall market is flat or going up a lot, there are investment opportunities for you to outperform. And we see those here today.
So speak about some of those opportunities in terms of bottom up. I wonder if you, for example, took a look at the Eternal outcome yesterday, and whether as a student of some of these companies, the shift in the management is something that you at all worry about, or you say, okay, Deepinder has built an institution. If you're not comfortable speaking about individual securities, that's fine. But just as a view on some of the stocks, some of the companies that you think are doing good work.
Well, if we take Eternal as a case study in management and organizational structure, there's a lot out in the public domain. It's worth investors spending time on that because their structure is unique. The way they have run that business is unique. You might know that they don't hire for a title. They hire the best people and they slot them in where they think opportunities match skill sets. So it's a unique company, and it'll be interesting to see how they execute over the next few years. But for people who know that company, they also know that while the company is associated with one person, it's not all about that one person. And Deepinder has a lot of other investments. I might get one of those things on the side of my head at the appropriate time. So he has a lot of ideas. I'm cheering for him.
Okay, so that's when you're talking about a particular case study, the way a person is managing it. But when you're talking about India, all this while we were talking about China plus one, a lot of other external factors as well. But now fund managers are talking about playing the domestic growth story itself, taking the tariffs into consideration because we don't know where it goes. I mean, last night you had Trump who came out and said that, okay, I'm going to be slightly calmer when it comes to Greenland as well. I am not really going to enforce things. Obviously, that can change in the next couple of minutes. If you have to then look at India from here on, and because you were underweight, is the domestic growth story as ripe for you to start putting in your money, and would it be domestic-oriented sectors?
Yes. So there are a few things to that question. Number one, in our Asia ex-Japan strategies, the broader Asia strategies, the India exposure that we have is very much to the domestic growth story, not necessarily exporters. It's domestic manufacturers, hospitals, banks, tech platforms. That is what we own in that strategy. Same here in our India dedicated strategy. If you look at the 200 largest companies in the world, roughly 72%, 200 largest companies in India, roughly 72% of the revenues are generated within India, and that number is growing. If you look at the S&P 500, and this is part of the reason why tariffs are not necessarily helpful to American companies, less than 60% of revenues are from within the US, more than 40 from outside, and that 40% ratio is growing. Whereas in India, that 70% plus ratio of domestic revenue is growing because the domestic growth is so high. Now, yes, many Indian companies are now looking to export markets, but the domestic story is very much intact. Whether it's cosmetic brands or financial services or telecom, hospitals, there's a lot of growth here. Defense, you mentioned China plus one. I think over the last year, some sectors have disappointed on that front. CDMOs perhaps, pharmaceuticals perhaps. But then there are, if you don't think about just China plus one, but the rest of the world versus India, defense is one area where we continue to go from strength to strength. We'll see what the budget reveals in a few days. But I think that's one area that has a long tail to growth when it comes to the domestic story.
Okay, and within the domestic story, if you have to talk about small and mid caps, are you seeing a trigger that could be coming in from a rotation, mega caps, small caps, mid caps? How are you seeing that aspect play out now?
We monitor our exposures by market caps. We are market cap agnostic. We try not to get too heavy into small and mid caps, partly for liquidity reasons, but also because of what we've seen over the past 15 months, the almost uniform selling in small and mid caps. Now, comparing to September 24, that was a very high base, and we do see some value emerging in these small and mid caps. Okay. But you have to do your homework. You have to focus on corporate governance, auditors, accounting practices, TAM. And also, just because an incumbent is large and seen as perhaps static, doesn't mean that they can't change. What we're seeing also is underperformance had been concentrated for a few years in the large cap names. But in some sectors now, the large caps are leading the way.
Because a theme that was front and center for 2.5 years, and that is the energy transition theme, and has suddenly got off rails. Now, I don't know if Trump's comments are anything to do with it, and I guess yesterday he kind of amplified that yet again, right? And drill baby drill seems to be the buzzword. But the earnings delivery from almost all the companies in the listed universe in India in energy transition is exemplary even in Q3. Valuations a lot more comforting. Is it a pocket to look at because India has set goals for 2030, or do you believe that the valuations are still in excess?
It depends on the company. We're seeing some of the solar companies rally today. Now that's because they had been selling off for an extended period. But solar over wind is our view. We have revisited the wind sector and companies that have direct and indirect exposure to wind. That is less exciting to us. Okay. Solar, perhaps. But there has to be an energy transition in India as well. If you look at China, they're leading the way. They're showing the world what that means. The US, in the short term, the direction of travel seems to have changed from the Obama years and the Biden years. But we'll see that could come back. Just focusing on India, however, investors should be focused on this.
Is the rupee where it stands right now an opportunity or a risk from your perspective for deployment of fresh funds? One would assume that because of the kind of drop that you've seen, it provides a great entry opportunity.
Yes and no. So again, for dollar-based investors, so if you look at the long-term earnings growth in India, 12, 13, 14%. Stocks follow earnings. But if you are an international investor, if you think that the currency will continue to depreciate 3 to 5% a year, let's just say 3% to be nicer, that's still going to eat into your returns. You have a market like Japan where earnings probably grow 8 to 10% per year, but then on top of that you have shareholder buybacks, you have dividend yields going higher. So it's plausible to make a case that even for a market like Japan, which is having falling birth rates, the economic growth has not been that high, but earnings growth has been high. You can get to double-digit returns there also. So then the growth ask for India continues to go higher. The difference, however, is that this is now a much broader and deeper market. You have, as I was saying earlier, we don't have the Mag 7, but after all these IPO listings in India, we now have close to 7,000 listed companies. So you have the Mag 7,000, not the Mag 7, which is heaven for an active manager. So if you do your homework, you have a market where earnings should grow 12 to 13%. Certain industries should grow faster than that. And because of the breadth and depth of the market, you should be able to find companies that are growing at a multiple to that also.
My last question to you is 2026, everyone's talking about a year where AI implementation will take center stage. Do you think the prospective earnings catalyst that could be coming in from there will make you turn overweight because you have been underweight on IT?
Don't think so. And I don't think that the most recent earnings changed our position, will lead us to change our positioning in the short term. We have some holdings, net we are underweight, but the AI deployment around the world is inflationary for tech hardware, which is why you're seeing semiconductor companies around the world doing what they're doing. They are deflationary for services. And for companies like the Indian IT services, again, not a monolith, all these companies are very different, but in aggregate, it's going to present growth challenges for them. In other industries as well, it will be deflationary, and this is what is missing in India. We don't have the tech hardware. We don't have the ASML equivalent or the Hynix or Micron or Samsung equivalent. TSMC don't have that here. Maybe in a couple of decades, but not right now.
Not right now.
Okay. Well, Vikas, thank you so much for sharing the stage with us today. Really lovely talking to you.
My pleasure.